Broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. Bobby Rains here for our once every 3 weeks Investors Observer members only workshop. Um, all right, yeah, welcome. Let's get started. All right, we have our standard agenda this time. I don't think we have any big Investors Observer updates since the last time when we talked about the new stock dashboard. We will be doing market update, and then the rest is member-driven content, questions, site demonstrations, etc. If you have questions now or you have them during the presentation at any point today, go ahead and throw them in the box. I have the box open here, so if it's relevant to what I'm talking about in the moment, I'll try to get to it then. Otherwise, we have plenty of time at the end. I can prepare slides for questions that are submitted ahead of time. I just mentioned the workshop, or respond to that workshop invitation, and I will get to those then. Thank you to those of you who sent questions in ahead of time today. All right, so with that, let's get into the market update. So this is our standard chart of 1-year daily candles on the S&P 500. The only thing really interesting here is I feel like we're getting back to the point above the 200-day moving average. That's sort of, we're not quite to the point yet where people are starting to talk about how far we have above the 200-day moving average, but you stretch it out too much further, it starts to get there, and this is pretty much as high as we've been above that level, or above that moving average this year, which is, yeah. Things can certainly go higher here, but they're already kind of high is really kind of the point there. And then, yeah, this is just the same thing, but last 6 months. So, yeah, you can see really, yeah, things have really sort of taken off here recently, although it's flattened out a little bit. All right, but if you look at the internals, things get interesting. So this is the S&P 500 versus the equal weight over the last 3 months. So the equal weight has actually outperformed, which typically means that the small caps are winning, right? So when the S&P 500 is doing better than the equal weight, that means the big guys at the top are usually powering things higher. Whereas when you have this sort of scenario, it usually means that the 495 that aren't Apple, Microsoft, Google, Facebook, and Amazon. Basically, this means the 495 are doing better, and the that big five is kind of lagging. Is what we're looking at here. So that's kind of interesting. Just that it's turned around. It seems like kind of not necessarily since the election, but I guess since it became obvious that Biden was winning. I don't know that there's any real reason for that, other than some things we'll talk about in a minute in terms of lawsuits. All right, so what else is happening in the economy? We're still very much in a virus-driven economy. Cases are rising again. Cold weather is pushing spending online. This tends to be good for big businesses and less good for smaller businesses. Right? Like a lot of small businesses don't have a robust online presence, or if they do, then they have, they can't pound on UPS and the Postal Service to give them sweetheart shipping deals, so they have to pay full freight, whereas Amazon, is a bulk shipper and probably has lower rates, things like that. So that's one thing to keep an eye on. Yeah, the vaccine does provide some light at the end of the tunnel. There has been some optimism in markets and just sort of in daily life around that, but that's kind of a ways off in terms of a widespread distribution. And new lockdowns are happening. And not only that, but we had data in the spring that showed that when infections started to get high in certain areas, people started to stay home and cut back on spending in any case, regardless of whether or not there were lockdowns in their states. We saw spending patterns move in similar ways in in Texas and New York is how JP Morgan tracked it. yeah, they're pretty similar, even though one of those states had lockdowns and the other one didn't. Stimulus is still sort of a possibility. The political calculations have changed since the election. Obviously, it seems right now like the likely outcome is sort of a smaller deal now than we were looking at before, and then some other deal in January after the inauguration. It's also entirely possible that no deal until January is what we end up looking at. But it's kind of hard to get that out. Yeah, the election is basically over. I would expect some amount of market movement around the January 5 runoff in Georgia, but I have no idea what to expect from that election, so I can't really tell you how, what I would expect the market to do in that case. Let's see here. There we go. All right, so that Facebook lawsuit that was announced today, it's a short-term problem for the stock. The stock was obviously down today, although at certain points the NASDAQ was down more than Facebook, which maybe says that the weakness in the NASDAQ wasn't just about this lawsuit. But yeah, this case isn't going to be resolved for years. And so it's a short-term problem for the stock. But in the, months to a year kind of time frame, it could be a buying opportunity, right? Like, yeah, there's a lawsuit. Okay. It won't be resolved for years. Until then, Facebook can keep doing all the things they've been doing that have, made the stock go as high as it is. Now, potentially there will be some slower growth, right? Facebook's going to have to think real hard about who they want to buy and what features of competitors they might want to copy and things like that. But growth at Facebook has kind of been slowing for a while, so it's going to be hard to tell how much of it is due to the lawsuit and how much of it is due to, just the fact that Facebook's growth was slowing. One of the things that people have said about the Microsoft, Windows Explorer, or I guess Internet Explorer lawsuit in the 90s was that it slowed down their innovation, right? They had to focus on not being a monopolist and couldn't just focus on growth, which is maybe a thing at Facebook, although I'm not sure Facebook has done a lot of innovating recently anyway. So it's, maybe they're about to drop something and it will blow everybody away. I don't know, but yeah, it's really hard to kind of know what happens at Facebook in terms of the product and things like that with this lawsuit. And yeah, the anti-competitive behavior here is buying their competitors, right? Like they bought Instagram, they bought WhatsApp. The lawsuit seeks to basically say you have to undo that. So what that means for shareholders is kind of interesting. My guess is they would probably get spun out, so you'd end up owning shares of Instagram or WhatsApp or something like that, or maybe sold to somebody else, however that works. If they're sold to somebody else, it's hard for Facebook to command a good price, but if they just spin them out into independent companies, the shareholders end up being kind of the same. I guess Zuckerberg would have to sell his shares, which would possibly put a lot of supply in the market, which could cause some weakness, but it's hard to know exactly what this means for shareholders outside of the sort of growth concerns. There are, I think, some sort of implications for other tech companies because, as I skip this bullet here, the Department of Justice approved the Instagram purchase and they approved the WhatsApp purchase. So these lawsuits signal some changes in thinking there. If they said it was okay to buy them and now they've decided it wasn't, that's obviously suggests that somebody changed their opinion. And so for other tech companies, I think in the short term, they're probably going to be careful in doing M&A. You don't want to buy somebody who looks like a direct competitor, especially if they're smaller and growing. And then, yes, some may also face some other antitrust or similar suits. There's been a lot of kind of noise about, like break up Amazon and things like that. but those are much harder to do as they don't have a big acquisition in the recent past like Facebook does, right? The Facebook lawsuit is interesting because I don't think there's a case previously where somebody has said, oh, you have to undo this merger because it's anti-competitive. But like something like Amazon, where I guess they bought Whole Foods, but most of their big business units they have, sort of built from the ground up. So it's harder to see the anti-competitive, acquisition or whatever in those cases. So yeah, I kind of expect, there's been a lot of noise about these sorts of things, but it's hard to know what that will take, and it'll be a very different legal argument than here, where it's just like, hey, you bought companies that were competitors of yours, you can't do that. All right, so some of the sort of what we've been calling the fast data in terms of economic data. This is Chase's consumer spending tracker. And yeah, basically what we have here is it's gotten real noisy. And that is because Thanksgiving moves around, being the last Friday in November, fourth Friday in November, whatever, fourth Thursday, sorry. Black Friday is the Friday after Thanksgiving, and that's the big spending day. So I think what's actually probably more noticeable here is we have this spike that is probably about Black Friday, and then we're kind of on average at or below the level we've been at since September. So we haven't really, so this is a year over year change chart. So we're just not doing much in terms of recovery year over year. Now, granted, there was a Christmas last year and a Christmas shopping season. So this is not to say that like, oh, we're not, right? Like there's obviously that spending happening. But it's on different days, so this chart doesn't line up as well. But the spending is at a lower level than it was last year. And then this chart, they very helpfully tried to line up the data so you can compare Black Friday to Black Friday and then the days before and the days after. And what this top guy shows is that overall spending is lagging last year, which is not surprising given this chart showing that spending is lagging. Oh, hold on. Yeah, so that's not super surprising. And also probably not really surprising if you think about it, is the online spending, again, is winning. So this is card not present. They can't actually tell which transactions are online. But card not present means you're not at the store swiping your card or sticking your chip in the thing or whatever, however it is you're making that transaction. So a lot of it is in-app or online shopping. And yeah, you can see that's running ahead of last year, even as the overall spending is behind. All right, and the TSA, traveling has really, there was we got a bump around Thanksgiving, and then it's back below, back to these sort of August, September levels. This might even be earlier in the summer than that. Yeah, it's really sort of fallen as the coronavirus cases have risen. I don't think that's super surprising. Also, people probably traveled for Thanksgiving and then are going to stay put for a while. We'll see if there's another bump around Christmas. But yeah, the story here is it's not really recovering back above this sort of, just above 500,000 a day sort of level. And last year, the average last year was closer to 2 million. And yeah, this is the daily rate of change in the 7-day average. And yeah, so it's again, right, it's showing more days where we're going down than going up, which is not surprising given the chart we just looked at. All right, on to the questions. So we'll do the pre-submitted ones first, and then I see some that are already in here. So we can go from there. So this is kind of an interesting one from John. He found this paragraph in an article, I think on MarketWatch, about JP Morgan's software analyst downgraded a bunch of stocks this morning. And so I'll read the passage and then we'll talk about it. He said, some high multiple software names could be in for a wake-up call come the June quarter. Wrote Sterling Auty, who downgraded a series of high-flying software names like Zoom, Okta, DocuSign, CrowdStrike to neutral from overweight in a Wednesday note declines. Audie stressed that the 20 highest multiple stocks at the end of 2009 outperformed the software industry average in 2010 after the financial crisis, a trend that could repeat once the economy gets back into gear. So I don't actually think the list of 20 stocks from 10 years ago is relevant to today. I mean, right? The Zoom, Okta, DocuSign, CrowdStrike, I'm not sure any of those existed 10 years ago. It's just not super relevant to today's conversation. Now, I do think this idea might be, but first, I think there's something wrong here. Because if you keep reading the article, you have a direct quote from the analyst where he says, "These ratings changes by no means reflect anything on the tremendous operating conditions of these names, but rather our view that an expanded economy could cause sector rotation and potential performance headwinds for these types of stocks like they did in 2010. So if you take the fact that he downgraded these stocks from overweight to neutral, and he says here, we think there's probably better opportunities somewhere else, which is what this means. I think probably what this should say is the 20 highest multiple stocks at the end of 2009 underperformed the software industry average in 2010. I'm not 100% sure, but these things don't all make sense when taken together. And we talked a little bit last time. But yeah, these names in particular, right? Your Zooms, your DocuSigns, these sort of remote work stocks are up huge this year, and it's hard to imagine the 2020 growth continuing into 21. Just think about the question of who is not using Zoom now that's gonna be using it in 2021, right? I mean, there's people come into the workforce all the time. There's some economic recovery. Or some economic growth that happens. But if the recovery happens coincident with sort of things reopening and people being back to, meeting in person and things like that, Zoom is looking at maybe flat to down. Later in the, not a JP Morgan client, so I couldn't get my hands on the note, but later in the article that, some of this came from, he talks specifically about sort of small companies that have 10 or fewer people who, right, that's probably one office in one city that everybody's working remotely now, and so they're using Zoom, and when they go back to the office, they may be using it way less, and so they may stop paying for it. So, Zoom in particular could lose customers in that sort of situation, whereas there are some small business opportunities, such as, right, like Intuit, which is accounting software, right? If you have a lot of small business formation, which often happens in recoveries after, recessions, things like, what is it called? Things like Intuit's accounting software that everybody uses that for some reason I can't think of the name of, see a lot of growth. Autodesk is design software. Wix does, websites and some online sales and things like that. So, companies go back into designing and growing, and you get new businesses being formed. Yes, Angela, thank you. QuickBooks, yes, is Intuit's accounting software. So yeah, those things might see more growth in 2021, given a reopening economy and some sector rotation than something like Zoom, where Zoom has grown so much this year. You basically said, okay, everybody in America, everybody who works on a computer in America has to work online. It's hard to see where you're going to get growth that looks at all like that in 2021. I have to work on two computers at once, maybe. Is a way you do that, but yeah, I'm not sure how else that happens. So that's what I think is going on there, and it's weird because I think there's a typo in the original MarketWatch story. I think this outperformed should be underperformed, but I didn't actually go back and do the 2009 to 2010 comparison either. All right, so we did get a question, a couple of questions really about how to enter a bull put spread. So I don't have an account at every brokerage that exists. And so I can't really provide a like screenshot of like, oh, here's how you do it at whatever broker there is, but they're all relatively standard. Anybody who's serious about offering options trading, which there are some relatively big names that don't allow you to enter multi-leg trades, but I think those are not serious about offering option trading. So that's a thing you should consider there is, do you really like your broker? Do you really want to trade options? But yeah, a bull put spread, like any multi-leg trade, should be entered as a spread. So the sort of advanced, people who are much more advanced can leg in and out of spreads and do things like that. But for what we're doing here, you really want to enter them as a spread. So that means you're going to do two things at the same time for a single price. Right? This is right. I don't do this when I buy a car, right? You have a trade in and they try to like say, oh, well, we'll combine your trade in and you got 6 transactions going on and you don't really know what the price of any of them are. That's really annoying when you're trying to buy a car or something like that and you're trying to sort of get the most out of each transaction. In a case like this, though, where we give you a price, a net price, you just want to put these two things in at the same time, not worry a ton about what the individual prices for the individual legs are. What you really care about is that net price. And so most of the brokers will let you put these in on a multi-leg ticket. It's sometimes called multi-leg or a combined ticket. Some of them have special tickets for different strategies in terms of like vertical spread versus calendar spread or covered call. But really what you want is a ticket that will let you put more than one transaction into a single trade at the same time. And the net price. So the net just means that you take the credit and the debit and you put them together and you get one price, either a debit or a credit, depending on, whether your credit or your debit is bigger and what your strategy is. But you really don't care about the price for the individual options. You care about the price for the total thing. All right, so once you find the order entry form, you're going to enter the ticker, and from there you're going to put in the details of your option, right? Your strike price, expiration date. For a vertical spread, the expiration dates will be the same. I've seen cases where there's a vertical spread ticket that only has you put in the expiration date once because there's only one expiration date. Sometimes the vertical spread ticket has you put it in twice. It really just depends on where you're doing the trading. But yeah, the strike prices will be different. And then one of them you're going to mark as buy to open if you're opening the trade, and one of them you're going to mark as sell to open. So in credit spreads, the strike closest to the stock's current price will be the sold one. Okay, so if it's a bull put spread like we're doing here, like we're talking about here, the bullish trades in the Investor's Keyhole and some other things you find on Investors Observer, the higher strike price, because these trades are right. So if the stock is at 50 and we say it's a 42 or a 40-42 bull put spread, that means you're going to sell the 42 and buy the 40 for whatever that credit says is. For debit spreads, it can vary, but the option that is either the least in the money or the furthest out of the money will be sold here. For call spreads, it just means the one with the higher strike price, basically. For put spreads, it's going to be the one with the lower strike price on the debit spread side. But yeah, so once you get that all set up, enter the details for your individual options. Now is when you care about an actual price. You only need one price. Investors Observer gives you that price. So it's the net price for the two options, or if it's a covered call, it's the stock minus the option. And yeah, for credit spreads, it'll be a net credit. For debit spreads, it'll be a net debit. So that is another selection you'll have to make typically on the order type. And that just means that, right, we're making this, it's a limit order. It goes in for the price. You get a better price or you get no trade. And that's especially with options when you're doing stuff like this where you have those multiple transactions going on. You don't want to try to optimize each leg of the trade and get the absolute best price for that, because then you end up with half a trade sometimes and you didn't want half the trade. It's a totally different risk. What you want is, I want these two options and I want this price or better. And so you put them in for limit credit or limit debit, and you put in that number that we gave you, and you're good to go from there. It'll either fill or it won't. The only other thing that they may ask you about is, it's called time in force usually. It's either a day order or good till canceled. A day order will sit on the market until the next close, at which point it's canceled. A good till canceled order is exactly what it sounds like. There's usually, if it's for a stock, there's usually something where they'll check with you after like 3 months or something, and say, yeah, hey, do you still want this order? But for option stuff, good till canceled, usually the options will expire, in a couple weeks or a couple months, so that's less a thing. And it depends. This is really a thing about style. I wouldn't leave a good till canceled option order just sitting out there, because after a few days, a lot of times for the market to hit your price, it's going to be pretty unattractive. So if you do use that good till canceled order, you may want to come back in a couple days and cancel it. It saves you from having to re-enter it every day, but I wouldn't just leave it sitting out there for weeks. All right, that is all the questions we got ahead of time. So let's go through what people have sent in since then. All right, so Steve says, my biggest flaw as an investor is not picking good companies, but rather having the patience and discipline to stay in those stocks. I tend to exit far too soon. Are there any suggestions? Yeah, I mean, it's hard to know, Steve, exactly what far too soon means. Does that mean the first down day, so you're picking good stocks and then selling them for a loss only to see them go flying back up? That's obviously not good. But I mean, there's also, you don't have to close a position entirely. We had a guy who used to work here who was much more of a, was very much a sort of buy and hold investor. And he would do things like, sell half the position if the stock doubled. Granted, stocks don't double super often, but if you're talking about a year holding period, he would do that. And so now he's still got basically his original amount of money in the position, and it's, he basically owns that for free now. And then he has some other money that he can reinvest somewhere else. So you can do things like that. But yeah, I mean, the rule that we use a lot of times when managing positions in terms of deciding to get in, obviously, but also deciding to get out, even on the option side where we have a pretty short time horizon, is, would I buy this today? And if the answer is still like, I might buy this today, then yeah, you probably don't sell it. Right? Like, you bought it for a reason. And so for you to sell it, something should have had to change your mind. Is, I think, maybe the best sort of discipline to kind of impose there, right? So if you're just like, oh, I have a gain, that's good. You could trim the position if you want to, but in terms of just closing it out altogether, has something come along that changed your mind in terms of, I don't like the stock anymore? But also, I would say that, like, selling a stock for a profit and buying another one that you then sell for a profit is not, I mean, there's tax implications and some things like that. But yeah, you can't, anytime you buy a stock today, or, make any trade or don't make a trade, there's probably something you could have done that would have made you more money. Right? Like, whatever it was that day, right? You probably, even if you bought the stock that went up the second most over that holding period, you probably didn't buy the stock that went up the most that day, or from your buy time until your sell time. And so trying to compare yourself to that investor is insane, because that investor doesn't exist. So yeah, it's hard to tell here if you're actually losing or just not winning as much as you could be. But yeah, I think, being more patient before selling in terms of, like, do I still like the stock? Has something changed my mind about it? On the exit is probably a good place to start there. All right, so Elena asked, do I use the trading view chart? I do. I'm not sure there's more question there to that, but I do use it sometimes. It's actually embedded on our website. Yeah. If there's more question, you can follow up. So when they add Tesla to the S&P 500 on the 21st, how do I think that will affect the S&P? So the way they do that is they sort of reindex everything, so there won't be an immediate price change. I mean, I think it will add some amount of volatility to the S&P. I don't remember exactly who's getting booted in place of Tesla. It's probably something like the 500th stock. Usually, they usually take out the bottom one. So yeah, I think that stock is probably a little bit less volatile than Tesla, but yeah, Tesla's been on a run. It may continue to be on a run. It may push the S&P 500 up some, but yeah, I mean, the S&P is 500 massive stocks, and Tesla has grown a lot and it's gotten big. But I think the effects are probably more likely to be on Tesla than on the S&P as a whole. All right, so let's see here. Rajiv said how to find option trades that are safe for a particular stock. So if you have a particular stock, you can just go to the stock page and click this options tab, and there's our trades for that. Also, we have what we call our out of the money covered call calculator. So if you already own the stock, you can enter a cost basis and it'll help you find a position based on that for a covered call. But yeah, so we have, our 7 strategies here. And so yeah, covered calls and short puts are going to be the sort of least risky, just on a per strategy basis, followed by the diagonal spreads, and then the vertical spreads and the condors are the riskiest. And then we also have our key ratings. So these obviously, right, I just said covered calls are the least risky, and then these down here are going to be the riskiest. So the key ratings are, right, like this is low risk against another covered call. This is slightly more risk against another short put is how that works. So it's not to say that this trade is safer than this trade. It's really just to say that, like, relatively to other bullish diagonals that we have today, we like this trade a little bit less than some others. But yeah, I mean, if you have a stock in mind, you can do that. Otherwise, we have our options screener, where you pick a strategy, and then you can go through and play with the filters a little bit. I usually don't like trades that are super long. So something about 6 weeks is usually about as far as I look most of the time. Put in some kind of annualized return rate. 20 is low, but it just knocks a few off. If you're doing 6 weeks trades, you can usually do better than a 20% annualized return. Yeah, I mean, the amount at risk kind of matters here. Something like 35 or 40 is usually as high as we go. And then, yeah, you can also, look at the overall scores. So I'd like to do, it doesn't need to be super high here because we don't actually need the stock to go up. So I like to find something that's, just a bit above average or better. And then key ratings, usually just look at the 4s and the 5s. And then you can actually sort, if you just want the 5 keys at the top, you can click on that and it'll bring those to the top. You can also sort by the overall score. If you hold down Shift after you've sorted once, it will sort within your original sort. So yeah, this sort of can help you to find those trades as well. All right. So Rajiv also said your deltas are quite high. Why? Yeah, without some more context, I can't really answer that. deltas for which trades, I guess, is where I'd start in terms of follow-up question. So where can you find large volume orders on options, aka unusual options trading? So we publish usually, most days if we can find a good one. One of our investors' keyhole trades is about unusual options activity. So we had this here. These can come in your email if you want to do that. There's also occasionally some other unusual options activity trades from our news provider, MT Newswire. But yeah, finding this stuff can be tough because trying to figure out, right, like finding a big order is one thing, but knowing whether it's a buy or a sell or an open or a close is harder. And so yeah, I kind of keep track of who does this. Yeah, and I know they talk about it on CNBC a lot, but you'll notice they don't talk about a lot of trades. They, usually have one or two they highlight. We have one or two we highlight a day. I don't know a good source for it other than, having access to just a big option book and spending a lot of time, looking at things. All right, so Paris says the assumed exit strategy on the bull put spread ideas is simply allowing the options to expire. That's correct. What is the stop loss strategy if there is a pullback? Yeah, I mean, we don't really have one. Typically, the way we manage these, like, in our portfolios or something like that, which, those tend to be a little bit closer to the money. So there is actually a pullback a little bit more often. My rule has always been the day I think the stock is more likely to be below that sold strike than above it is the day I start looking for the exit. And so, yeah, I mean, just doing that will help you a lot. I don't think there's a percentage. Yeah, I don't think having a straight percentage or other kind of stop loss strategy is a particularly good idea. I feel like you get a lot of losers that way. And sort of, I guess a corollary to Steve's question from earlier about when to sell. One of the things we always try to figure out here is, okay, is my stock down today because the market is down, or is my stock down today because something happened to my stock? And yeah, having a stop loss strategy doesn't actually do that calculus, right? So, if you got weeks to go and the stock is right around your sold strike and the market has been bad and you expect the market to turn around in those coming weeks, maybe I don't get out of that one. If the market's doing great and the stock is right around my sold strike price because something's going on with my stock, that one I'm going to get out of. So it's really sort of, just kind of being aware of what's happening with the stock, right? Like, especially in the investor's keyhole, those trades you get by email from us 4 times a day, those are 10% out of the money to start with most of the time. And so if those are starting to get close to your strike, it's probably something happened to the stock. So I would try to figure out what that is and figure that out. Okay, yeah, I mean, Rajiv, so talking about I don't think the deltas are particularly high on those trades. I mean, those are 10% out of the money. They're relatively low, I would say. All right, so in the stock screener, is there a way to filter stocks trading at 52 weeks highs and 52 weeks lows? Not currently. We do publish an article about that, usually around mid-afternoon every day. It shows up here. in this top news section. So we do publish that, but it's that data isn't currently available in our stock screener. All right, are there any short call strategies? I only see short puts. So the covered call is a short call strategy, right? You're selling a call. The reason there are no short call strategies otherwise is the short call as a strategy, like a naked short call, is not a strategy that most investors are like even have access to. And the reason for that is, okay, if I sell a put, potentially I'm obligated to buy the stock at the strike price of that put. Okay, and so what can go wrong is the stock can go down, and then I have to buy the stock. Well, okay, that's not great, but the stock can only go down to 0, right? Like after that, it stops. And so my risk is defined there, right? My broker knows exactly how much risk I have. They can say, "Up, you can't, you need more cash on this," something like that. That it's a defined risk and it's easy to manage. On the other side, though, on the call side, if you sell a call, potentially you have to buy the stock, but there's no upper limit to stock prices, right? Like there is no 0, right? It just goes and can keep going. And so basically you're short the stock with no, there's no automatic breaker there. So there's no real limit to how much risk that is. And so that's why there's no short call strategies, because it's not a good idea to do that. We have bearish bearish vertical spreads, which are functionally you're net short a call in that case, right? It has the same thing, but there is some downside protection there. And that's a much safer strategy because you can control the risk there. Yes. So for Thor, the options screener, the short puts, we do all the math here as if they're cash covered in terms of the amount at risk and things like that. Whether you're doing them with some margin or not is entirely up to you. But the idea here is sell a put. So that's your cash covered put right there. It's just strategy short puts. Okay. Okay, so Susan asked, how do you use the options dashboard? So the options dashboard is really sort of a landing page, right? The idea is you can sort of come here and then go to something else. There's also some quick reference stuff, right? So we have our options, our model option portfolios that you can get to from here. We have these 2 trades open right now. And we'll probably be opening more as time goes on. We've got your featured trades and the personalized trades here. You can pick a strategy you want, and it'll just show you up to three trades every day. We don't have a trade for everything every day, but usually they're in there. Then we have news sort of about the stocks in the option portfolios, other things that are relevant to option traders. Morning update and investors keyhole trades are here. You can get to the option screener from here. Our market sentiment indicator. But it's really just sort of a landing page designed to be kind of a quick reference to get you to somewhere. All right, so this is a question I'm getting a lot just generally, not just in this workshop. But Bob says, on the portfolio page, how do I make additions and deletions? I'm assuming you're talking about the My Portfolio page, Bob, which is here. And yeah, those should be made automatically through the linkage. It's once a day. Usually it should be fresh for you every morning. If it's not, there may be a problem with our third-party data broker, which is Plaid, and your broker. But you could also send us a support ticket about that, and we can answer that question on a broker by broker, account by account kind of level. All right, so Banal says, beginning investor looking for long-term recommendations, and how can he consider buying from the preset screens? All right, so let's go to the stocks dashboard. This is one of the things we added when we did the stock dashboard, was these sort of preset screens. And so yeah, what you're going to want here is, maybe something like good value, ugly chart. You say long-term investor, it's hard to know what that means. For some people, that means 6 months. And for some people, it means, well, I'm 25 and I'd like to retire at 65. Those are, right, 1 year versus 40 years is obviously a very different time frame. But yeah, something like good value, ugly chart, deep value, those are the kind of things that are typically, what longer term investors are looking for, right? These stocks are unlikely to double overnight, but they are, in most cases, pretty good companies that are, for whatever reason, undervalued. And so those are the kind of things that, that's the sort of Warren Buffett, Ben Graham, long-term investing, kind of strategy there. Any training materials for options? So we have a help center that has a whole lot of stuff about options. We also have these workshops every 3 weeks where people can send in questions, and I will tell them, as much as I can in terms of how options work or whatever it is you want. So that's, if you have a specific question that you can't get covered in the help center, by all means submit a question for the workshop or just send us a help ticket, and we can answer things there as well. All right, so here's a good one. What do I think about Airbnb tomorrow? So Airbnb is having an IPO tomorrow. DoorDash had an IPO today, and it was crazy. The stock priced at 102, which meant that $102 per share went to the company. And then it started trading today at something like 182, and then it closed at 189. And so basically what that means is that the people who bought in the IPO, not the people who were the first traders in the market today, but the people whose, basically preferred clients of investment banks, got shares at $102 per share. And then some of those people were able to flip the shares immediately this morning for an $80 profit on a $102 investment, which is nice work if you can get it. That's kind of extreme. I don't know that I expect Airbnb to do that tomorrow. That's a little bit nuts, but the IPO market has generally been a little bit nuts. We have something like, I think, 4 SPACs IPOing this week and a couple more next week. And a SPAC is just somebody says, hey, we're going to have an IPO and we don't even own a company. We just want to raise money from the market and we'll figure out a company to buy later. And those are going off like crazy. So there's just a lot of energy in the market for IPOs. I expect it to come out and pop somewhat because it's Airbnb, as people have been waiting for it for years. I'm not particularly a big believer in buying IPOs, especially a lot of these tech companies that are either unprofitable and have no plans to be profitable, or are, you can go and read the S1. I haven't read for Airbnb, but if you go read the sort of use of proceeds section of their SEC filings, where they say why they're having an IPO, the traditional model was, oh, companies go to the market for money to fund their growth. But more recently, what we've seen is we're going to create a public market for our existing shareholders and things like that. And so what that means is basically, the company doesn't really need the money they're going to get from IPO investors. What they're trying to do is create a market so early investors can realize some profits. And I don't really, I think each IPO should probably be taken on a case-by-case basis. But as a general rule, if the early investors are looking to cash out, I don't know that I need to be the next guy in. So I generally kind of, keep an eye on those things, but I don't have a ton of interest in trying to buy them. Okay, so when an option expires on a sell to open, how is the credit calculated? So the credit is what you sold the option for to begin with. Right, so if you sell an option for $1 and it expires worthless, you made $1. That's the credit is calculated when the trade is opened, because when it expires worthless, no money changes hands. All right, so when I link my account, will I be able to manage my broker? No, the linkage is one way. You can't send any information back to your broker from our website, but you can you can see what our scores and analysis is on the stocks that are in your broker. So the stocks in the featured trades are picked, largely by algorithm. There's some, there's some sort of look over to see sort of what's in there. We adjust how it works periodically. But yeah, I'm not going to give you the whole secret sauce there. It's a combination of algorithm and some analyst looking over the machine's shoulder to, make sure we're okay with what's happening. Do you think the rest of the market will get crushed with tomorrow's Airbnb? I don't. I mean, they'll probably raise, billions of dollars, but I don't. I don't think that everybody's going to sell all their stocks to buy Airbnb tomorrow. That's not really how that works. Please show how you compare 3 stocks. All right, so we have these compare buttons scattered around the site. Almost anywhere you see a stock, there should be a compare button next to it. And so if you want to compare some stocks, you can just click this compare button, and it adds it to this kind of tray here. And so once you find the stocks that you want to compare, you just hit the compare here, and that lines them up side by side. You can do up to 4. You can add another one from here if you want to, throw in another stock from there. You can. And then, if you decide, oh, yeah, I really don't like this guy, you can take him out and add another one from there, or you can go back to, back to wherever you were and get a new one, and then come back here, and the 3 you had are saved, and then your new one is over here. It's a little bit like the sort of online shopping experience in terms of being able to put those things in there like that. All right, could we explain the forecast graph? Sure. So this guy right here. Basically what happens is we get some data from Wall Street's analysts, however many there are covering a given stock. Microsoft has a lot. Some small cap stocks have a lot fewer. And the data is sort of pre-aggregated for us. So I don't actually know how many analysts are covering Microsoft. But they all have something approximating a 12-month price target. And so the lowest analyst's price target is 203. The high one is 260, and the average comes out to 240.41. Okay, the current price is 211.80. The 52-week high is this, and the 52-week low is that. So yeah, that's the chart. And so the thing about this is these prices can move. They're not just going to be static for a year and then everybody updates. They will, they'll move as analysts change their forecasts. All right, so I think I'm going to wrap up here. This session, like all of our workshops, was recorded. We'll be sending out a a recording tomorrow, video, link to download the slides, etc. So you can look out for that. There'll also be a link to register for our next workshop, which will be probably about 3 weeks from today. Probably not. It'll probably be early January. I don't think we're going to do one between Christmas and New Year's. Yeah, so it'll probably be in early January. So look out for that. We'll have that. Yeah. All right. So are these numbers low, median, high expected? Yeah, I mean, that's some analysts' forecast for what the price will be 12 months from now. Well, the high and the low are some analysts' forecasts for what the price will be 12 months from now. The mean is just the average of what all the analysts' forecasts are. We don't currently let you search on forecast just because it would be, yeah, what we have plans to do at some point is let you search on the percentage change to the forecast. So like just searching for $240 wouldn't make a ton of sense. Searching for, up 10% or more would probably be how we would make that work. Yeah, so if it's all green, it just means that all the analysts have a higher price target than the current price. That's probably relatively safer than something where all the analysts have a price have a target where the price is lower than the current price. But it really kind of depends on the stock there. I just have a couple of questions here I'm going to follow up with by text.